All right, let's get right into it. We've got a popular Bitcoin-based token that just imploded. We're talking half its value gone in a flash. Now, the team behind it says one thing, but the market data, well, that seems to be telling a totally different story. So, what really caused the core crypto crash? And get this, we're talking about a 51% collapse in just a few hours. This wasn't some slow, painful bleed over weeks. Nope. This was a straight-up catastrophic freefall that left the market completely stunned. And right out of the gate, you've got these two competing stories. On one side, you have the development team, Core DAO. They're claiming this was a market-driven event. Basically, hey, the system worked exactly like it was supposed to. But then you look at the on-chain data, and whoa, it tells a much more chaotic story. A story of pure, unadulterated panic. So let's start at, the scene of the crime. We're going to break down exactly what this 51% collapse looked like and why it was such a massive deal for this token. And the numbers here are just stark. The price got sliced in half, crashing to an all-time low of just over 3 cents. For a token like Core, this was completely uncharted territory. We're talking about a price level that just erased months and months of stability, gone in a handful of hours. Okay, so what was the official story for this disaster? Naturally, the Core DAO team rushed out a statement to try and calm everyone down. Let's dig in and see what they had to say. Basically, the team pointed the finger at two main things. First, a bunch of really big sales hitting the market all at once. And second, that initial selling triggered this crazy domino effect on a lending protocol called Colend. And this is where it gets kind of wild. They called it a liquidation cascade. So what does that even mean? Well, it starts with those big sells, right? That pushes the price down. But that drop then triggers automatic liquidations for any traders who borrowed money against their core tokens. That forces even more selling, which triggers more liquidations, and, well, you get the picture. It's this absolutely brutal feedback loop. And it's one of those high-stakes features of DeFi. When it's working right, it's supposed to manage risk. But when it breaks, well, it looks exactly like this. So, from the team's point of view, the crucial thing to understand is this. Their protocol didn't break. They're arguing it did exactly what it was designed to do under extreme pressure. They're framing this as a painful, sure, but necessary shakeout. Clearing out all the people who are borrowing too much. It's this whole self-correcting mechanism idea that a lot of DeFi projects talk about. Okay, but let's move on to the actual evidence, because while that explanation sounds pretty clean, pretty technical, the raw data from the blockchain, it starts to make that neat little story a whole lot more complicated. And this really is the key question, isn't it? Was this really just the system cleansing itself? Or was it something far more chaotic and completely out of control? And boom, this right here is the biggest red flag of them all. The trading volume in just 24 hours shot up to $130 million. Now, hold on. At that same time, the token's entire market cap, the value of all core tokens, was only 34 million. The trading volume was almost 4 times the entire size of the project. That's just insane. To put that into perspective for you, that's like imagining every single share of a company like Apple being bought and sold almost 4 times in a single day. It's a completely staggering number, and it points to something way more violent than some orderly shakeout. Yeah, data like that isn't the signature of a planned event. That's the signature of a classic crypto panic. It's called a liquidity flush. It's that terrifying moment where all the sellers, human and bot alike, just completely overwhelm the buyers. The price floor doesn't just drop, it completely vanishes. And look, this isn't just a core problem. This is a huge vulnerability for any token that doesn't have deep liquidity. It's a risk that's just always lurking right below the surface in the world of DeFi. So this huge, completely unnatural trading volume, it led all the on-chain sleuths in the crypto community to a totally different theory. They stopped looking at the system and started looking for a person, or at the very least, a single powerful wallet. And yeah, the suspicions started to build fast. First, people got worried when the project locked the comments on their official announcement. That's never a good look. Then, the data itself seemed to be pointing to one single massive seller. And pretty soon, the community started asking all those tough questions you hear whenever this stuff happens. Was this market manipulation? Was it an insider dumping their bags? Or was this a classic rug pull?
And guess what? They actually found something. These on-chain detectives, they identified one single wallet that allegedly dumped almost 3 million core tokens right when the crash kicked off. This one wallet could have been the tiny spark that lit the entire bonfire. And it just goes to show you another huge risk in crypto, right? Token concentration. When one anonymous wallet holds that much power, this whole idea of a decentralized market starts to look pretty darn fragile. And one analyst, Moon Jeff, he argues this isn't just about core. He says it's a symptom of a much bigger problem. He points out that the core crash is just a textbook example of a fragile market structure you see all over DeFi. It's this dangerous mix of high leverage, not enough buyers, and these big anonymous whales who can just trigger a collapse whenever they want. And the scary part, what happened to core could easily happen to dozens of other tokens, like tomorrow.
So, okay. We've got two very different stories on the table. Where does this leave the price of core right now? Let's take a look at the charts and see what the technicals are suggesting. All right, so this kind of sums it all up. The overall feeling in the market is, no surprise, extremely bearish. The fear and greed index is screaming extreme fear. But look at that RSI number, the relative strength index. At 9.45, that is just profoundly, deeply in the oversold category. So what does an RSI that low actually mean? Well, it signals that the sellers are just completely exhausted. It's what traders call capitulation. Everyone who was going to sell has sold. And while things look absolutely terrible right now, a number that low is so rare that it can often signal a sharp, even violent rally in the other direction once the selling pressure finally dries up. It's that classic fear and greed cycle just cranked up to 11 because, it's crypto.
So, at the end of the day, we're left with this huge question that goes way beyond just one token. Was this a market-driven event, a sign of a healthy system fixing itself? Or was it a liquidity flush, a symptom of a market that's fragile and super easy to manipulate? And look, the answer doesn't just matter to people holding core. It's a critical question for the entire DeFi space, because it really gets to the heart of whether these systems are truly as decentralized and strong as they claim to be, or if they're just a new kind of casino, where the house and a few big whales always have the upper hand.